Welcome to the daily update. This is Being Prepared Monday, October 3rd, where we'll look at the action in the market today and then see how things look for Tuesday, October 4th. We had a really solid update. If we were ever going to find support, if we ever saw a convergence of a lot of our signals coming together at the same time, if we saw sentiment all getting fearful at the same time, you bring all of that together and we saw a pretty solid bounce. The big question now is, where do we go from here? Is this just another dead cat bounce like we saw last week? Or is this the beginning of something? We're coming into a more seasonably favorable time of the year. We finally got through September. We're into October. That oftentimes can be a better time frame. The markets have really freaked out, and it doesn't seem like it's ever going to go up ever again. That's where we're getting our sentiment indications from. That quite often is when a good bounce can happen. But we have to be really careful of this. We have some things that are starting to develop that have not lasted very long and led us astray before in 2022. We had last week where we saw a nice little bounce only to see all that given back and then some the very next day. What's going to happen now? So let's just look at the charts. We have to sit back and evaluate where things are at right now and then form our plan and then go forward, and then seeing how things play out in Tuesday's session. Will that plan continue to move forward, or will we fall back and regroup again? So let's go back and talk about what happened. We did have a higher open. It was a bit of a gap higher, but there was some initial selling right off the bat that kind of brought things down, which can be understandable. You have a lot of folks that make their decisions over the weekends, and they might make it Friday night, Saturday, or Sunday. They execute their orders. Those immediately are executed once the market opens on Monday. That's why we see a lot of the gyrations that can happen at the open. That's why I don't really pay attention to the open, other than if we're going up or down at any given time. And then about an hour to an hour and a half after the open, that's when I start to look things over. But it's really after the lunchtime, about the last 1 to 2 hours. That's when I really start to pay attention to what is price actually doing. But we did have a higher open, and this pushed us immediately above R1, which was at 36.43. Now we had a really big spread between our pivot points for today's session, so that made the pivot points for today's session quite wide apart. As the day went on, we did see a little bit of a retreat. You saw that blip up, and I'll show you the chart. We came back down slightly, and then buying continued. We didn't get all the way up to, it should have been R2. Sorry, that's a mistake on here, which is at the 3,700 level. We got close to 3,700, but we didn't quite get there. Going into the close, we did see some weakness coming into the close. Things fell back slightly, so we closed off of the highs. We ended up being up 2.59% on above average volume. The technicals, they're still negative overall. This one day phenomenon isn't changing things all that much. It's improving things. And now we have to see follow through. Now we have to see, what is the market going to do? Is it going to take this and continue to run with it? Or are we just going to work off our oversold condition before we get set to go lower? Inflation and interest rates, yeah, they're still the real fixation. And I'll point it out in the next slide. We have this same scenario starting to creep up right now that I'll go through. A lot of geopolitical concerns. Things seem to be calming down a little bit in the UK, and I'll address that. We're still hearing a lot of rumblings from Russia, and then that also goes into the Russia-Ukraine situation, which could come into the Europe situation, which could come into the US situation if it really starts to escalate. So there's just a lot of things going on right now that are unsettling, to say the least. We do have some earnings reports that are coming out. We're not really, I don't hear a lot of debate going back and forth about the debate with the recession. It's like either you think we are or we aren't, and things are not very good right now, no matter where you come out with your definition of a recession, and then any Fed speak that may come out. So, some comments. We had a really strong start to the week, the month, and to the quarter. So, this is the first session that we had for the fourth quarter of 2022. We're bouncing right now. We still have to call this a bounce from oversold conditions because we're still oversold right now. We did improve, but a lot of our charts haven't just automatically turned and gone the other way. Some of them have, but most of them that we get longer term indications from, they're just starting to turn up and show some improvement. But a big thing, and I tried to point this out in the other videos that I posted, we were at major support on the weekly chart, and I'll show you this. We had come down to that 200-week moving average. That's long-term, heavy-duty support. We closed right at that level after Friday's session, and we came up off of that. So that is potentially quite positive right now. But as I said, we still remain oversold. Interest rates fell. That gave some support to stocks going higher because the UK, if you remember some of my other videos, or maybe you've heard about, the new prime minister there promised all these tax cuts that were especially for higher earners. Well, they decided to not do that after all. So that helped things a little bit in the UK. And then in the US, our economic reports that I'll go through here in just a moment, they were weaker than expected. The ISM manufacturing and construction spending came in weak. But this is the concern. Already, we have one good update. We saw it last week with the update that we had. That crazy scenario that, oh, the Fed is going to turn more dovish and inflation is going to come down and they're going to start to maybe pause at raising interest rates, if not even start to lower them. Typically in a normal time, which we're not in a normal time, that would be okay. But we've had at least 4 times in 2022 where the market has run higher on this scenario, only to be dashed down by specifically Fed Chair Powell. He comes out and says, no, we're not going to stop raising interest rates. We're not turning more dovish right now. We're going to remain hawkish. And that's still the word coming out of the Fed. We haven't heard anything about that. But anytime we have an update, anytime interest rates start to go down, it's like this scenario just gets weaved into the market. Now, eventually, it'll probably be true, but we've been bitten. If you're a longer term investor and you got into some of these bottoms that we got into to go up only to come back down, you're pretty gun shy right now. Could this be the time that it really starts to take hold and keep the market going up higher? I would be very suspicious of this scenario. I would just watch the charts, watch things on a day in and day out basis, and then reassess things as the need arises. But to latch onto this idea that we had interest rates down, we're having an update, so yeah, that just means the Fed is just going to start turning more in our favor. They're going to pivot. Well, there's really not anything right now that to suggest that the Fed's going to do that, other than people thinking that it might happen. Okay, we still have our different yield curves that remain inverted. Sentiment, even though it ticked up a little bit with the update, it's still fearful and pretty extreme. The IHS Market Manufacturing, this is not a really big one. It came in at 52. The last time we got this, it was at 51.8. As long as we're above 50, that's considered to be expanding. If we drop below 50, that's when the economy is contracting, according to this report. But this isn't a real mover. This next one is ISM Manufacturing. It came in at 50.9, and we're going through a period right now where bad news is good news, because this came in weaker than expected. They expected it at 52. It came in at 50.9. The bond market really liked that. That gave some support to stocks because bonds were going up as interest rates were going down. And so if we see weaker than expected economic reports, that might help out the stock market. But it's also going to feed into this pivot in that the Fed may do Don't fall into that yet. It may happen, but we have to see something more official from specifically Chairperson Powell saying that the Fed is actually going to pivot, but we're not getting that yet. Then construction spending also was weaker than expected. They expected it to be down 0.2%. It was down 0.7%. Last month they revised it. It was down 0.6%. So we're seeing that slowing down things in the economy as well. Our trend is still negative. It's going to take a while for that ADX to really switch over. We're still above 20. It's still above the moving average. I have switched our bias to positive just because of the solid day. We were up over 3% at one point. So that you don't see a lot of those moves. But on the other hand, some of the biggest up moves you see are within the context of a bear market. And we are still down heavy with the S&P. So is that one of those bounces? We don't know yet. We just have to watch and see how things play out. Be defensive, be careful with any convictions that we might have. I'm still keeping our momentum at negative because we just had the one up day with a whole lot of down days thrown in there. So sentiment, it ticked up a little bit, but we're still below 25. So we're extreme fear right now. You can see over here how it is bouncing up slightly from that extreme negative reading, which is a good sign. This is where these kinds of things start if we're going to get a sustained bounce. The Isabel net charts, this is just showing, now I'm seeing a little contradiction here. A lot of the reports show that housing prices still continue to go up overall in the US. This chart is suggesting, that's the orange line here, that they're still going up. They're up 16%. And there's no legend here to tell me what this little dot means, but they are coming down slightly. But when you compare them to the UK, Australia, Sweden, Canada, New Zealand, housing prices overall are really starting to decline. And if you're more inclined to go to Sweden or New Zealand, they're actually going down. They're actually dropping more negative currently. Here, this is the M2, and I talked a little bit about that in the last video. This is the biggest measure that we have since we don't have M3 anymore. There are some pseudo type indicators that we can use to try to mimic what M3 did, but this is the official report. This just says if M2 in US dollars continues to fall at the pace that it's been falling, and it has, it's really been coming down. That's the blue line. And then the green line is decreasing at the current pace of 750 billion per month. That's going down too. This does not bode well for stocks. Well, if you think about it, that makes sense. In 2008, where did we get the bounce from? Quantitative easing. After the COVID plunge, where did we get the big run up from 2020, the recovery, and then the big move higher in 2021? Quantitative easing. They're taking that money out right now and they're lessening their balance sheet. And so there's fewer dollars out there to chase bonds and stocks, which keeps interest rates low and pushes up stock prices even higher. And this shouldn't necessarily be a surprise. This just means to me that now we have to go back to more of the fundamental looks of things. How is the S&P looking in and of itself without all of this stimulus being thrown behind it to help stock prices? Or what we've seen a lot in 2022 is this decline has really been hurting stock prices because there's just fewer dollars out there chasing the stock market. Here's the S&P 500. It's when it gets down to 20% below its 200-day moving average. This is a longer term look of the chart that I show in every video. It just shows that we've really gone extreme negative here. And sometimes this can suggest a good entry point. I'll show you the chart that I have later on. We are bouncing up a little bit from that level, but this just gives you some different points in history. And think about this: Great Depression, world was coming to an end. World War II, that wasn't a positive thing. The Korean War, there was a flash crash in 62. The 70s, which just sucked economically. Black Monday in 87, the dot-com boom and bust, the great financial crisis. These are when things really went extreme negative. Of course, COVID. But that ended up being the time to buy. When everything's on fire and still smoldering, that's when the smart money comes in and starts to buy stocks when nobody else seems to even want to have anything to do with them. Just something to be aware of. We don't know if we're at that point now, but we could be, especially with this convergence of all these signals coming together at this time. But we need to see follow through. This is a couple days old. This is the latest reading from RIDEX with the bear bull ratio, how it's really spiking up. These folks have a tendency to react to what's going on in the market. And as it has been going down, more folks have been getting into the bearish funds, which really sucked for these folks on Monday with such an advance because they got in on Friday. This is dated the 30th of September. And only to see, especially if they're in some of the leveraged funds, my goodness, they lost 5% of their money if they were in some kind of a juiced or enhanced mutual fund. So that's why we watch these things, because these folks tend to do the wrong things at critical points. Also, the mass index, not we're just watching this for right now to see if it does have the ability to get above the blue line. It actually turned down a little bit with the up day. So, not quite sure. We'll just see how this plays out. Also, here's the G4 central bank's balance sheet. You're seeing money coming out of central banks now as they're not doing quantitative easing, they're doing quantitative tightening or tapering or whatever you want to call it. But this has really been coming down. The dark blue area here is the Fed. Then we have the European Central Bank. They're really taking things down. The Bank of Japan, not as much because they're having a different kind of problem there. The Bank of England, which is green, which is in here somewhere. I can't really see it. And then total overall. And it just shows that all of the central banks' balance sheets are starting to be lessened with what they have on them. And that's really putting some pressure on stocks. Here's another one that kind of mimics the chart that I look at. But remember, this is before Monday's session where we had come down and broke below this low. Well, now we're starting to come back up into this area again. But just something to be aware of. Different trend lines. Here's the trend line that we broke that started this whole mess. Can we start to get some support and continue to go higher, or have we now broken below this enough so that we're going to keep going lower? Sentiment still not really extreme, but it's at minus 1.1, which is considered extreme. That kind of goes hand in hand with our fear and greed index. Here's another index also getting over into the extreme fear area. So we're seeing a convergence of different sentiment indicators. This is showing the 2-year treasury yield, which is at 4.2% against the dividend. Yeah, how do you like that? How many folks actually invest in the S&P 500 for the dividends? It's at 1.8 right now, and you're taxed on that after corporations are taxed on that. It's one of those double taxation things. A lot of times what people will do is they invest in stocks, not so much because they go up or down, but because they get a dividend. Well, some of you might actually get into preferred stocks, which are generally not as bouncy or not as volatile in their price, but they tend to pay a higher dividend yield. But this is just comparing the current yield in the S&P, which is so low and has been low for a long time because a lot of the S&P is made up of growth stocks and they don't give dividends in a lot of growth stocks. For years, Microsoft never did that because they took that money and plowed it back into the company to help the stock price go up. Not that they're giving some of their income to shareholders. But the treasury yield has really been spiking up compared to the dividend rate. So this might be some support for bonds, which could ultimately help stocks because folks is like, wait a minute, we got the 2-year yield. That's giving us the highest return right now. Why don't we jump into that? And people are buying that, which pushes prices up and interest rates down. And that could also feed over into the stock market. All right. Then we have hedge funds. What are they doing right now? And what are some mutual funds that can maneuver and do different things? Well, how exposed are they to stocks right now? where it says hedge fund net leverage. That's the dark blue line. They're still 65% invested, according to this chart, in stocks. Where the mutual funds, that's the blue line, they're still 2.5% invested in stocks, which, this is mutual fund cash percent of total assets. I'm sorry. That would be crazy because these mutual funds have to invest in stocks. They're only at about 2.5% in cash right now. But this is just showing that there's still a lot of people that own stocks out there. Continuing jobless claims. Last video, I showed initial jobless claims. This is showing how we're seeing a decrease in continuing jobless claims, which is adding to the employment situation, which incidentally will be coming out on Friday. We get the big report the first Friday of each month. And when you compare it to other years, it shows how we're much lower and we are currently declining. This is part of the justification for the Fed to keep doing what they're doing. They want to see weakness in the employment situation before they're willing to stop raising interest rates. The only problem is they keep raising rates and there's a considerable lag time from the time they push rates higher until it actually works its way through the system. And by the time it works its way all the way through, then quite often they have a tendency to overdo it. And now they're trying to fight just to keep the economy afloat. Anyway, one thing that was interesting about Monday's session is that we were up across the board, but look, value really outperformed growth. This did not help our sector rotation charts. They're still declining. Now, the mid caps, we did see growth outperform value. Little bit of an underperformance in the small caps, but the fact that these are all green is just kind of positive in and of itself. We haven't seen that in a while, but can it continue? All right, with the update, the VIX is continuing to decline on a closing basis, and we closed right near the bottom of the bar on the bar chart here. And the VIX of the VIX, as it's coming down, the VIX of the VIX is also declining. Ulcer index also coming down. And then we're down 23.66% from the all-time high. And here is the closing bar, how we've come back up into this mess or base or plateau, whatever it turns out to be. But at least we were able to come back up where it looks like we were just going to go for a free fall down below it. The equity put call ratio declined with the up day. We are declining after really spiking up. This is one of our possible positive scenarios. When it goes this high and comes down, that can give some support to the S&P. Looking at support and resistance, and incidentally, I'm putting this chart that you see right now on the community tab of the YouTube channel. I'm going to start posting that because some of you use that. But if you'll do me a favor, if you go to the community tab, which a lot of people don't even know, what community tab, YouTube, what are you talking about? Go to the channel that I have. And now that I'm over 500 subscribers, there is now a thing called community. You click on that and it's like a blog post type of a situation. Not a lot of people really use that in YouTube. Some people rely on it heavily, but it kind of goes hidden by a lot of folks. If you go and look at that chart and actually use it and find it helpful, please click a like on that post. And I post 2 charts, and I'm going to start doing that. I just kind of want to find out if this is helping you or not as I do the video. So if you do look at that, just click like. I usually don't ask for those things because my philosophy is if I need to ask you to subscribe to my channel and to click like every other video on YouTube does, I don't want you watching my videos. You're smart enough. I want smart people watching these videos, and I don't need to tell you that. You're going to like what I do, whether I ask you or not, and I'm just wasting your time. Okay, off my soapbox. Looking at our bar chart, daily bar chart, see how we came back up above the support level. And so we're kind of back into the middle. This is an improvement on above average volume. Here's the other chart that I'm posting on the YouTube community tab. And these are good for the whole month. The reason why I update this every day, I just put in the current candlesticks for that particular day just to give you some reference point. So you'll see this chart and the other chart there. We're coming back up from having a 100% retracement in our intermediate term fib levels. That is positive. We're still kind of in no man's land. And yes, I know I have the highlight up here. I forget to keep moving it down here somewhere, but not really helping us. We're kind of in between with our longer term fib chart. This is the biggie. And I pointed this out in the daily video. I really tried to stress it in the weekly video. We came all the way down to this 200-week moving average. That is a big deal. Just think how long 200 weeks is on a weekly chart. That goes back a long time. And we came down and settled right at that area. And the fact that we bounced up off of that, that could be very healthy. If things turn and start to go back down and we break below this, that could be very negative. We're coming back up slightly in the overall trend channel, but we're still below the midpoint. Currently, looking at the sectors, all of them were up with energy, materials, tech. They're all doing really good. The one that was up the least was discretionary. It was only up 0.10, but still it was positive. And the only sector that has a really stellar looking chart right now is still energy at 98.3. It's showing a lot of improvement lately. All the other ones are in the 80s, 60s, blah, blah, blah. Communication is still in single digits at the bottom. Here's our sectors. Energy showing some strength. Utilities are still negative, going back to the all-time high. And all of the other sectors continue to be negative, with communication in last place and discretionary in second to the last place, with tech third to the last place. Here's just an update of the percentage changes since the S&P made its all-time high. All the technical alerts were positive. We had the S&P go above 3,600, and I was watching that 3,700 level. I thought, no, we're not going to get up there. Well, we didn't quite get to that 3,700 level, but we got pretty close. And the NASDAQ made a lot of headway, getting up above 10.6, 10.7, 10.8. You were seeing some BPI crosses from extreme negative. They're crossing above 20. We had the euro against the dollar, because the dollar, if we're really going to start to go up here, the dollar is going to see some weakness most likely. So that means the euro is going to be picking up some strength. It had a bullish MACD crossover. And then the NYSE, where it had gone extreme negative, it crossed back above 20. So we're seeing broad-based oversold conditions and a bounce coming up out of that, which could be positive. The mid caps are still in first place at a paltry 54.1. Nothing to brag about, but showing some improvement. The Dow is in second place at 51.7. Small caps, they are bouncing up slightly. With the SPY, it's kind of hanging in there. It's not showing, because it went right back up into that conglomeration of prices where we've already been, but it did show some improvement. And the Qs, which they actually went down a little bit in Monday's session. The Qs, and which is the NASDAQ 100 and the NASDAQ, that's where we're going to get the real bounce from if we're going to start to really move higher. Here's our intraday chart, where we did have a nice move up. There was we were just kind of jockeying around. So I just said this was a higher open. It looked like we were going to open higher than we actually did, but we just jetted up above R1. We kind of floundered here a little bit. This is the little bit of weakness that we saw, and then we just saw continued buying as the day went on. We never made it up to R2 at 3,700. Our high was at 36.98. So do you think 3,700 is a resistance level? Yeah, and then just a little bit of selling to take us off the highs, but still a pretty respectable day. Our trend, the selling pressure has come down. The buying pressure is starting to increase, but we're still in a negative trend overall. Our Arun is still looking extreme negative, because we're going right back up to where we were not so long ago. So the Arun's not picking up anything new right now. Breadth, we saw another major upthrust day above this blue line based on price, and a good solid move up based on volume, but we've got a lot of damage to repair for things to improve. Our advanced decline ratio, after getting really extreme negative, is showing some improvement. The highs and lows, kind of flattening out here as we're seeing a contraction of the new lows, but we're still going lower with the 10-day differential. Accumulation distribution still below a declining moving average, but showing some improvement. Short term, we might have overdone it. Going back from Monday session to Friday session, we really shot up pretty quick there. And the advanced decline ratio, man, look at this. We went extreme positive. This was last Wednesday. Then we came down here. We went extreme negative, bounced around a day or two. Now we've gone back to extreme positive again. So we might be seeing some overdone it on a one-day basis. Doesn't necessarily mean we have to stop going up. It just means that we might slow down a little bit to give these charts a chance to readjust. Going back on our rate of change 10, we did show some improvement, but we're still extreme negative. Stochc RSI looking much more positive, coming out of an extreme negative reading with the Williams percent R. We're really starting to move up. You can see the circle here. That's where the force index is currently. This gave us a little bit of an indication, at least so far. On Friday, this was actually starting to point up, and it's pointing up on the weekly chart as well. And we saw some follow through, and this is still negative because it's below this 0 point, but showing some improvement right now and continuing to point higher. McClellan oscillator also coming out of an extreme negative reading and showing some improvement. We're seeing a lot of improvement with the 20, 50, and 200, but we're still extreme negative. Our stochastic short term trying to peek its head up after being extreme negative, turning up a little bit intermediate term, and still trying to wake up down here with the longer term stochastic measure. Intermediate term still looking extreme negative with the Sean trend meter, still going. All our oscillators, it takes them longer to readjust, so our PMO is going down still. PMO study showing some improvement with those that are rising, turning up slightly, but still extreme negative with the buy signals, and still declining with those that are above 0. Chaikin oscillator showing some improvement, but not really big. Chaikin money flow showing a little bit of improvement. Seeing kind of above average volume right now, so that's a little bit helpful, but it was down from Friday's session because we had the last day of the week, month, and quarter going on there. The vortex continues to be negative, but is coming down slightly as the buying power is going up. Because the McClellan oscillator continues to be negative, that means our summation index is declining based on price, and we're just kind of turning sideways a little bit based on volume. Sometimes volume with the summation index can be a leading indicator. And here's all of our oscillators, which are like, what? Well, something happened on Monday. Well, maybe we should think about that, but they haven't really started yet. BPI, after being extreme negative, is starting to bounce up. Ease of movement showing some improvement, but still below 0. Ultimate oscillator also turned up. Money flow index, where we have not had a reading in over a year, extreme negative. Well, we got one, and we're starting to come up out of an extreme negative reading here. The CCI, and if we do keep going up, I'm going to take these charts off. The 14 period is coming out of extreme negative, as is the 20 period. RSI also, if we continue to show some improvement, these will probably go away. The RSI 14 is looking a little better. The RSI 9 is also starting to advance after being extreme negative. The boom indicator still has a ways to go when you compare it to the 50 period moving average and then the 200. Both of these have some damage still left to do, but they're showing some improvement. Dow theory saw a little bit of a tick up with the Dow itself, the trannies, and even the utilities, where we're seeing, even though utilities didn't make a lower low here, this was actually a confirmation when you look at just the Dow and the transports together. TTM squeeze still hasn't, it's looking negative right now. Balance of power showed a little bit of improvement. This is technically a signal now, a confirmed signal based on the CMB composite index. When we came up and crossed above the red line, that was the enter signal or buy signal here. And when it crossed above the green line, that's supposedly a confirmation. So if you use this indicator, it gave you a signal. How valid it is or not, we don't know at this point. Heiken Ashi, we're looking at more of a doji type look currently, which is an improvement after all these black candles. We're still negative, but showing improvement with the Kegi chart. See, we're still red, but we're going up right now. Renko continues to be negative. 3-line break is actually showing an open candle. That's more positive. Nothing new on the point and figure chart. It's still picking up this triple bottom breakdown. The Elder Impulse is switched back to neutral for the SPX and for the SPY. But the SAR continues to be negative with the dots on top. We're still deep purple with the go, no-go system. Longer term, showing improvement with the 50, 150, and 200, but look at how far down these things are right now. Rate of change going back 200 periods also really has barely turned up, and it's going back down to where we were at the COVID lows. Special K continues to go lower, and it's going to take a lot to turn that thing. Diamonds are back to neutral for the Dow, and here's the Dow coming right back up, and see how it came up to this previous pivot level, and that acted as resistance. We're neutral with the Qs right now, also coming back up to this pivot point right here, went a little bit above that. So the market's got its work cut out for itself if it's in fact going to go higher. The Vixen did decline with the update, both with the bar chart and on the line chart. The NASDAQ also came right up to this pivot level. Mid caps actually came right up to the pivot level. That's acting as resistance. We closed a little bit off the high, but we were pretty much going sideways with the mid caps. That's why it's in first place right now. It's looking a little better than some of the other charts. The Wilshire also showing some more improvement with the up day. The dollar is starting to come down. Of course, now that we had a couple of down days in a row, everybody's saying, death of the dollar, it's just going to go in the tank. And okay, we're still in an overall uptrend overall, even though we're seeing some weakness. There may come a day when the dollar does die, but it's probably not going to be for a little while. That's because all the other currencies in the world are even worse. And the British pound is also starting to come back. It had got down all the way to about 103 here. Now it's back up around 113. So that's starting to stabilize a bit. The S&P to the dollar, even though this turned up slightly, they still have a pretty strong inverse relationship. Gold was up pretty strong on Monday. Of course, now everybody's saying, look at it, it's breaking out, man. It's going to the moon from here. Well, we've seen these kind of moves before. We're still in an overall downtrend. And silver actually had more of a breakout, but it's still in an overall downtrend. If you use it, or if you make decisions based on the trends of these charts, some people just buy it. They don't care what's happening. Oil did go up to 83.63, so it's back above 80 now. The correlation between the S&P and oil, well, we had oil, it's starting to come down a little bit right now, but it's still having a tendency to go in the same direction. Bonds saw a little bit of a bounce based on price, but we've got lots of damage that has been done here. The 10-year treasury yield, after moving up to almost 4%, is now coming back down to 3.651%. The 30-year has also been retreating slightly down to 3.73. Stocks and bonds are still having a pretty strong tendency to go in the same direction. This could be helpful, especially if bonds continue to go up. And if stocks continue to go up, we will see this relationship strong. The reason why the relationship is strong is because they both have been going down. We'll have to see if they can both switch to going up. Our yield curves, no changes here. 10 to the 5, 10 to the 2, 30 to the 5, still all inverted. Coming back down slightly with the 10 to the 3 month. It had really spiked up, but we still have not gone inverted yet. Tech sector to the 10-year yield, also pretty strong inverse correlation. As interest rates go up, tech goes down, and vice versa. Yields declined, especially in the longer, or the higher yields, I should say, came down. We did have the 3 month really spike up. Our scenario showing some improvement here. We've come up out of the above this red line, which is an extreme negative reading based on price and volume, which again, if you look at when this happened, a lot of times that gave some significant support to the S&P. We're also seeing, when we look at our 200-day moving average, and that's similar to some of the Isabel Net charts no, that was the 20 period that I don't really deal with. That's a little too short term for me. But we're seeing a little bit of a bounce here after not quite getting down to this extreme negative reading, but it is showing some improvement. Here's the 50 period starting to bounce back up with the S&P, the mid caps, and the small caps. So we're seeing some improvement right now. The 10-day average of the highs and lows in the S&P, it hasn't changed. It's still pegged because it needs to see some more internal weakness before this thing starts to move up. So we're not getting confirmation from this. And the 5-period moving average, looking at the broad market, it's showing some improvement. It came back above this extreme negative red line. And the equity put call ratio going over 5 periods, the long-term chart, it's starting to come down after giving us a pretty solid spike up. And again, when this happens, often that gives support to the S&P. Small caps, they were up, but they're still kind of looking more like the mid caps where they've been going sideways. But this is starting to go up a little bit when we compare the small caps to the S&P, but we're not really seeing a spike up yet. If we got to see follow through here, not just one really good day. The S&P to the 10-year also having a tendency to go in opposite directions. Here's our sector rotation. See how we continue to decline with the Qs to the S&P, discretionary is falling off, and large cap growth to large cap value also declined. We saw more of a healthy environment for value stocks on Monday than we did for growth stocks. Large cap growth value ratios declining. Mid caps actually came down a little bit. And look at small caps. They were the one part of our sector rotation that could be giving us a glimmer of hope right now because they actually advanced slightly. We'll want to keep an eye on that. The S&P to the 2-year yield also going in opposite directions. So we did spike up. We've come back down slightly, but we don't know right now if this is going to continue to fall. The ratio between the S&P and the utilities, it's continuing to show some improvement. This could be providing some support for the market as well. Staples were up, but not as much as the rest of the market. So our spike is now going back down. So right now, this is looking like it could be valid, but we get shifted into the other direction and this thing could spike right back up pretty quickly. So what's our outlook for Tuesday? Our technicals are negative, but showing improvement, but we're still oversold. And we have to ask, can this continue? Now, right before I started recording, I was looking at the S&P futures, but this is many, many hours before the open of the market. We were up over 1%, like 1 to 1.25%. That could change because there's a lot of time yet before the market even opens. But if we're going to kick into gear and really get moving higher, having the futures strong overnight is one part that could be helpful. We have factory orders and the JOLTS job openings coming out. Geopolitical events, we've got the whole gambit here. Things that I've talked a little bit about, but really for the stock market, it's inflation and interest rates, but the Russia-Ukraine situation, the things going on in China, any one of those could always come to the forefront. It looks like things might be getting a little bit better in the UK. The last thing I heard about the Nord Stream pipeline is that suddenly those leaks stopped. Figure that one out. I don't know if that's even true or not. So our scenarios, we still have to go with the down scenario, but we're still oversold and we're rebounding from that oversold condition. So we can't take a lot of confidence in that right now. We can't go up yet because we're not seeing a lot of follow through price movement currently. And we can't go sideways necessarily because the ADX is above 20 and it continues to be negative. So our conclusion, we're negative and potentially rebounding from being oversold in all the different time frames right now. Not really rebounding yet in the long term because that takes a while to do from being oversold. So thank you. I hope you find this helpful. Have a really, really good Tuesday. I will look to prepare the video for Wednesday's session and have a very, very good day today.